Tyler & Co. is a world-renowned saxophone manufacturer based here in Stockport. So the business owns its own trading property, a mega collection of rare vintage saxophones, and it generates a significant amount of cash. So, those of you who don't know, Andy Tyler also plays a lot of saxophone in his spare time, and we just thought this would be a little bit of fun. But would you believe it, saxophone manufacturing is actually a really, really risky business. So the directors of the business are very concerned that should, a team member or a client have a nasty accident, that they could be sued by millions. And that would put their cash, their property, and most importantly, their vintage saxophone collection potentially at risk. So Paul, what should they do?
Well, so if Brian the cleaner does stick his hand in a machine and have it cut off and turns the business for millions of pounds, then, as Sarah says, at the moment, the way it's structured, all of those valuable assets are exposed as a result of that. Now, this is, I guess, to be clear, and I need to be very careful because I am conscious there's some lawyers in the room, so forgive me if I kind of overstep the mark a little here. But essentially what we're looking to do is we're trying to find a way to quarantine those assets away from the trade. So if something does go wrong with the trade, we're essentially protecting those assets, and effectively it's only the sort of trading assets that are exposed in that situation. The way that we do that is we create a holding company which sits on top of Tyler & Co. And essentially that then means that we can move those valuable assets out of the trading company into the holding company. So if the worst happens with the trading company, then the assets are kind of quarantined. There's a firewall between them and the trading business, so those assets are protected. So worst comes to the worst, you could cut the trading business loose but still have the cash, the premises, and most importantly the saxophones, as Sarah says. And the way that we do that, to kind of make sure that that's a totally tax-free transaction, is what's called a share-for-share exchange. I won't bore you with the details, but essentially what the owners do is they swap their shares in Tyler & Co. for shares in the new holding company, and so the holding company's transferred tax-free underneath, the trading company's transferred tax-free under the holding company. And obviously, whoever the accountants are have to prepare another set of accounts, which is a real shame. And but fundamentally, we can then transfer. Sorry. We can then transfer those assets in a tax-free way up to the holding company, and the holding company has other benefits as well. It gives you a different degree of flexibility. If the owner decided that he did want to sell the trading business but keep the property and the saxophones, etc., then it gives you a couple of options as to how you can structure that sale as well. So I think in a society where you can get sued for drinking a cup of coffee from McDonald's and burning the roof of your mouth, then that whole risk thing has suddenly gone a lot higher up people's agendas. And I think being able to protect all that value that Mr. Tyler has worked very hard over many years to create is really something that we do talk to a lot of clients about, and I think people see the benefit in doing that.
Fantastic, thank you. So now you've put Mr. Tyler's you've put him at ease now. He's feeling more confident that his business is well protected. The founder and main shareholder, Andy, is now in his mid-70s.
I'd just like to point out, it was suggested it should be mid-80s, but I did point out that
there's not as much time for planning.
Yeah, exactly, yeah. Limits the options.
And he's noticed that IHT, or inheritance tax, is suddenly big ticket news, and everybody seems to be talking about it. So much so that his mates in the pub keep suggesting that he should gift his shares or stick them in trust, but that's all a bit complex. He'd thought that he didn't have an IHT problem, not only because he's going to live forever, but because the shares in the company are exempt from IHT. So Paul, he's not sure that his mates in the pub know what they're talking about, or his mates in the band know what they're talking about. Does he have an IHT problem, and what can he do about it?
Well, as matters stand, provided Andy dies before the 6th of April 2026, then no, he doesn't have an inheritance tax problem. So, sorry. Now you know why I'm going to a client meeting straight after. So, because essentially, as matters stand at the moment, if you've got shares in a trading business, then from an IHT point of view, those shares are totally outside the IHT net. And the old mantra was genuinely that death is often the best form of tax planning as far as IHT is concerned. Now, 30th of April last year, Rachel Reeves stood up and changed the ball game on that completely. So from 6th of April 2026, businesses such as Tyler and Co are no longer going to be entirely outside the IHT net. So from 6th of April next year, everybody's going to have £1 million allowance, which is totally tax-free or IHT-free from a business point of view if it's a trading business. But above that, there's going to be an effective rate on the value over £1 million each of 20%, which is going to be payable. You know, they've generously said you can pay it in 10 equal instalments, interest-free, so that's very kind of them. But fundamentally, people who sat there for many, many years thinking the best thing I can do is hold on to the shares till I pass away, hand them down, and you actually get some CGT benefits from doing that as well. That whole idea has just gone completely out of the water. So we are looking at you know, for a lot of clients about, well, how do we deal with that? And obviously, you know, I'm not going to mention the B word, but there is the possibility that, you know, the Chancellor stands up in a couple of weeks' time and throws a total hand grenade into the mix again and changes everything. But as Matt stand at the moment, we're looking at things like, so Andy's right, his mates in the band are right to a certain extent, looking at things like gifting. You know, can we gift the shares in lifetime, so as provided that you kind of stick around for 7 years after the gift, then it's totally outside the inheritance tax net. Can we look at transferring some of these shares into a family trust, for example, that could be for the benefit of the next generation or even, you know, generations to follow beyond that, with the idea of taking as much of that value out of the estate from an IHT point of view as we possibly can, and ideally keeping the value in Andy's estate below £1 million. Now, I understand that although Andy has a life partner, he's not married, which limits our options from an IHT planning point of view, because transferring to between a married couple is exempt from IHT. Transferring between unmarried spouses is not exempt from IHT. So that would just be a normal gift. You know, genuinely, we do have conversations with clients about, well, maybe, you know, you've been together for so long, maybe you ought to think about tying them up. I've not been set up to say that. Just looking at the cold, hard facts, that's all I'm doing.
Shall we move swiftly on?
We'll probably move swiftly on,
Let's move swiftly on. So now that Andy is feeling that the future of the business and his shares are a little bit more secure, he's suddenly realised only now that the company's managing director, Sarah, is critical to the future success of the business. So he wants to reward her and tie her in for the long term. He was going to give her some shares. I knew somebody was going to say that. To the business. So he was going to give her some shares, but apparently, according to his mates in the band again, there's a big red flag around that. There could be a tax issue. Rachel may want to get her hands on some of that.
Yes, and I think that's absolutely the case. And actually, I recall it was a while ago, but we had a Marketing Stockport event at the Hat Museum, I think, where the guys from SAS Daniels did a really good presentation around some of the other issues that are associated with gifting shares to employees. But from a tax point of view, if Andy chooses to gift shares to Sarah, then the employment-related securities rules kick in, and that sounds really boring, but what it essentially says is that if Sarah gets shares and she receives those shares by reason of her employment, she's taxed on the value of those shares as if she'd received that amount in cash. So actually, you can give somebody shares and give them a big tax problem at the same time. So, you know, I think it's very much an approach with care kind of situation, and we do see clients genuinely out of all of the best motives give shares away, and then find that they've got a tax problem. Now, there is an exemption from those rules where it says if the gift's made in the normal course of people's family or domestic relations, then you can actually manoeuvre yourself out of those rules quite legitimately. So it's not but you can imagine if it's an employer-employee relationship, HMRC are going to struggle with the concept that it's part of your normal domestic or family relations.
So what could we do?
So essentially, you've got two. We've got a number of options, but the two options that we see most often used are are what's called enterprise management incentive options or growth shares. So very briefly, an EMI option is what we call a tax advantage share scheme. What that essentially means is that the tax treatment is modified. So what an option is, as you probably know, is if you don't get shares straight away, but you've got a right to buy shares at some point in the future. Most often in these kind of schemes, it's tied to a point where the business is sold, but it doesn't necessarily have to be. But the benefit of the EMI option is you value the price that has to be paid to buy the shares at today's date, rather than at that future date when you're buying them. And there's no tax implications for buying those shares at that cheaper price. As long as that price is no lower than the market value today, you can buy them when the business is increased in value by 10 times in 5 years' time, and still actually only pay the value of today's date, and the individual becomes a shareholder. There's no income tax consequences for them in that situation, and they only actually pay tax even when they sell those shares. Now, going back to the SAS Daniel's presentation, you also want to make sure that if the employee decides to leave and go off to work for the competition, you want some rules around essentially saying, well, you've got to hand those shares back if you're actually a shareholder at that point. And if they have the option and leave, the option, to quote Anne Robinson, they leave with nothing. Effectively, they walk away and the option dies at the point that they walk away. So that's one option. It's very, very tax efficient, but it is kind of tied to there being some event at some point in the future that allows the employee to realise value. And if Andy wants to hand the business down to the next generation and the next generation, that potentially could mean there's no exit event, and so how do you get value out of that at that point? There are ways, and which we can set up structures to allow that, but it starts to become more complicated. The other option, growth shares, or the other alternative, should say, using option does confuse the issue. So the other alternative, growth shares, essentially what a growth share says is, if the business is currently worth £2 million for the sake of argument, that share only starts to attract value once the business exceeds a certain value. So you might say, okay, we want to give Sarah a bit of an incentive to continue to grow the business. So we say, actually, until the business is worth £2.5 million, Sarah's shares aren't worth anything, but once it's over £2.5 million, Sarah gets 10% of the excess over that value on an exit. So again, tied to an exit, but Sarah's a shareholder, which gives her the ability to receive dividends, which, as we know, although they're not as tax efficient as they used to be, are still a more tax efficient way of remunerating people. And because there is a kind of a gap between the value that we've got today and the value at which Sarah's shares kick in, then we can effectively argue with HMRC to say, well, come on, those shares at this point in time are worth nothing. So yes, Sarah should be taxable on the value of those shares when she gets them, but because they're worth nothing, there's actually no tax exposure. So it's a couple of alternatives. It's horses for courses. Some people want individuals to be on the share register and feel that real sense of ownership. Others want that bit more control that they get with options, where they know that if the individual leaves, it's much easier to just say the option's cancelled rather than having to get the share back.
Fantastic, thank you. So finally now, Andy's feeling pretty chilled, pretty relaxed. That's freed up a little bit of brain space, and he's now thinking about the longer term and thinking, actually, why am I working so hard for so long? I'd much rather be playing my vintage saxophones than working in this manufacturing business. And we've got a great team, and Sarah's now not going anywhere because she's got those golden handcuffs. So, and he's also realised, very reluctantly accepted the fact that none of his family are really interested in the saxophone business. No idea, it must be all of those long notes practiced in the attic for years. But he also doesn't want to sell to one of his major competitors. So he wants to get out, he wants to retire. He hasn't been saving into his pension, so he needs some money to live on. Doesn't want to do a trade sale because his competitor's product are just completely inferior, and they've got no after sales care, and he just thinks it would destroy the culture of his business, and he's very proud of what he's created. So what can he do?
Well, one of the options is, and you'd almost think we'd prepared this, wouldn't you? One of the options is actually to sell the business to an employee ownership trust, which is, sounds obvious, it's a trust that owns the shares in the business, but the trust is set up specifically to own the shares for the benefit of the employees. So it's not employee ownership in the sense that the individuals have their name on the share register again, But the trustees of that trust, their sole responsibility effectively is to make sure that the business is run and all decisions are taken with the benefit of the employees in mind. So the idea being that it drives greater employee engagement. There are ways that, you know, the business can pay the employees tax-free bonuses over the course of the year. It's capped at $3,600 a year, but it's a nice thing that you can do. It's a little bit of extra for these guys to feel, actually, I'm starting to really share in the success of this business. If the business is sold down the lines, there's quite a lot of tax to pay, let's be frank, but actually the employees would then get a share of the after-tax proceeds as well from the sale of the business. So there's a real sense in which they can see their efforts contributing not only to value for Andy, but also value for them as well. And there's a lot of research that shows, if done well, employee ownership trusts really do drive employee engagement and make people feel like they genuinely got that ownership interest in the business. From Andy's point of view, the big advantage for an EOT, subject to anything that happens in the B word in a couple of weeks' time, and I've no reason to think this will change, is that essentially if you sell the majority of your shares to an employee ownership trust, then effectively that sale is totally tax-free. There's no capital gains tax to pay on the sale of the shares to an employee ownership trust. So from Andy's point of view, typically what will happen, you've got to make sure that you get an independent valuation to make sure the value they're paying is appropriate. And that would probably be less than what you'd get on a trade sale, particularly if it's a strategic acquisition. But the idea is that tax-free sale then kind of compensates and gives the owner an incentive to actually sell to the EOT rather than looking to just realise the best price, bank the money, spend it all on saxophones and sail off into the sunset. So there are a lot of advantages. I think that the key thing that we always say to clients is, if the first thing you think about is you can sell it tax-free, you're probably doing it for the wrong reasons. And as Sarah says, the event tomorrow is all about, you know, okay, we've got to day one and we've sold the business to the EOT, but there's a whole load of stuff that you need to think about. EOTs are for life rather than just for Christmas, I think, is the key message. So it's and often from a seller's point of view, the proceeds, the considerations deferred over quite a long time because it's the business that's funding the amounts that are getting paid for the business. So it's got to be done for the right reasons. It's absolutely got to be done right, and there are lots of things that you've got to think about afterwards. But if you're looking to preserve the culture of the business, you want to sort of protect the business, you really want to recognise that massive contribution that the employees have made over time, the EOT really is a great option. And if Sarah's got her EMI options, she can probably exercise those at that stage, buy the shares and actually get some value out of the EOT as well. So it's definitely approached with caution. It's definitely not the right answer for everybody, but in the right situation, it's a great answer for the shareholders, but it's also should be a great answer for the employees into the future as well.